Your Money and Your Life is proudly brought to you by Get Credit Score, Superhero and CoinSpot.
Coming up on Your Money and Your Life, how to supercharge your superannuation. Are cashbacks worth it when taking out a home loan? How to look $1 million without spending it? And this week's top share tips from the experts. Welcome to Your Money and Your Life, the show that helps everyday Aussies to save, invest and enjoy their money. Well, this week we're kicking things off with a topic that affects every single working Australian: superannuation. It's one of the biggest financial assets people hold, and yet stats show around 43% of us are either not taking it seriously or making super mistakes with it. Ben Nash from Pivot Wealth joins us today to stop us from sabotaging our financial future. Ben, how are you, mate? Good to see you. Now, what are the big mistakes we're making in terms of sabotaging our future?
I think one of the biggest ones is that people just bury their head in the sand when it comes to their super. We know that it's important, but it ends up in the too hard basket. Life gets in the way, and all that time we've missed the opportunities to take action. Your super isn't something that needs a lot of work, but it does need to make sure that you get it right, because the changes that you make now have the biggest impact, 10 or 20 years from now. Okay,
so why is superannuation a good tool to grow our investments?
Once money is inside super, it's taxed at a much lower rate than our personal income or investment income outside of our superannuation. And then you've got the fact that you can get tax deductions on the contributions into super as well. It means that you can use super as a tool to really accelerate your wealth creation. You need to balance it against the ability to access the funds, because obviously you can't get your super until you hit that retirement age, but those tax benefits are compelling.
So how do you choose the right super fund for you?
It really comes down to the investments that you want to be having in your fund first, and that can be a good way that people can narrow down the options that are available to them. If you start just trying to looking at all the funds out there, it can be pretty overwhelming. But if you realise that you want to invest in a socially responsible way, then that will narrow the list down. If you want to use a fund that has good passive index fund options, then that's going to narrow the list down a bit more. If you want to have a fund that has more interesting investment options in there, that narrows the fund down again. So set your investment philosophy or your investment mandate as the first step, and then look at a fund that can deliver that mandate in a way that has a good user experience, but also competitive fees in the segment that you're playing in with your investments.
Right. Give us some strategies to supercharge your super.
Well, there are some different contribution strategies that you can use. We've got, for people that are looking to buy their first home, we've got the First Home Super Saver Scheme, where you can contribute up to $30,000 pre-tax dollars and then use those funds to purchase your first home. There are some risks with that, so don't go blindly into it. Make sure that you get some good advice before you go down that path, but that can be a good way to help Aussies get into their first home sooner. Then we've got a concessional contribution, so you can contribute up to $25,000. That limit is about to increase in pre-tax dollars, including the money that's put in by your employer. That can be a really good way to get some good tax deductions and get money into your super in a way that you don't feel as much out of pocket. And you can now also, for people that have balances below $500,000, you can catch up on unused concessional contributions or pre-tax contributions from previous years, which can be a good way to get a good chunk into super and really push down that donation to the ATO.
So when you get a bit of cash in the future, use it, any bonuses, to really put extra into superannuation?
Well, you can do that. You can nominate with your employer to salary sacrifice things before tax, like before you even get the bonus. But these days, the government have also made it really easy to just put money in out of your bank account and then claim a deduction after the fact, which in my view is a bit more of a flexible way to put money into your super, because you can look at what happens at the end of the financial year, see what's the really optimal way to amount to contribute, and then put that amount of money in instead of if you put too much in and then you get a pay rise or a bonus that you weren't expecting, then it can mean that you just end up in a strategy which isn't quite as good as what you would choose if you had the full information.
Great tips. Ben Nash from Pivot Wealth, always great to see you, mate. Thank you.
Good to be here.
After the break, we compare cashback home loan offers to find out just how they stack up. But first, let's take a look at your credit score. A credit score is important when it comes to your borrowing power, as it's one indicator of your credit risk. The higher the score, the more reliable and creditworthy you appear to lenders. But just how is it calculated? A credit score is a number between 0 and 1200, calculated based on the information held in your credit report. Now, anyone who has ever applied for any type of credit will have a credit report. Credit reporting bodies often use these various algorithms to calculate your score, and it can fluctuate as information on your credit report changes. If your credit behaviour improves, then your score can also improve. Your credit score is affected by a range of factors, including how many loans you've applied for, the amount of money you've borrowed, and your reliability in making those repayments on time. The higher the score, the less of a potential risk you are. The higher the score, the more borrowing power you may have. The bottom line is to start getting savvy and know your credit score before you apply for a loan or any type of credit.
Hi, I'm Julia Lee from Berman Invest. Most people, when asked about what they'd like from their investments, usually answer something like, make lots and lots of money. And that's what investing is about, generating returns. Yet, when confronted with the share market moving up and down, there's a perception that it's just too risky. There's a reason behind this. The prospect of losing is about twice as powerful as the pleasure of gaining. And understanding this very human quality of loss aversion could be the key to becoming comfortable with risk. When it comes to investing, there's definitely a trade-off between risk and return. The lower the risk, the lower the potential return. The higher the risk, the higher the potential return. After all, if a high return investment contained no risk at all, it should be giving you the same return as a boring, low-return bank account. So when it comes to investing, understand risk, embrace risk and use it, because without it, investing would be similar to leaving your money in a boring bank account.
Now, if you're looking for a home loan, you may have been offered what appears to be a pretty attractive cashback sweetener. It's all the rage from banks and lenders at the moment, and on the surface, it can seem pretty enticing. Take out a loan and then get a couple of grand back in cash. But how do they actually work, and are they worth it? Do the numbers really stack up? To answer those questions, we're joined by Kate Brown from finder.com.au. Kate, good to see you.
Thank you.
First of all, just explain how the cashbacks work.
Look, you might have heard of cashbacks around retail. You used to be able to buy a flat screen TV and you'd get some cash back. It's exactly the same with home loans, and we're seeing this a lot at the moment because the refinancing area particularly and new loans is really competitive at the moment. We've got super low interest rates. A lot of lenders are competing for customers. It's as simple as you said. If you take out a home loan with a cashback offer, if you meet all the criteria, you can get up to $4,000 put in your account once it's done.
$4,000?
Yeah.
That is a lot of money, isn't it? And really enticing. Are they worth it, though?
Well, there's the saying there's no such thing as a free lunch. They can be, but the secret sauce to cashback is you have to do a lot of hard work to get that money. And in the case of home loans, the first thing is that they're primarily focused for refinancing at the moment because they're a bit simpler for banks to process. They know you're a good deal. There are some around for first home home buyers, but they're a little bit more complex. So first of all, you want to be a really vanilla kind of offering. You don't want to be private, self-employed, for example, or have any interesting things about your loan because they can be restrictive. The other thing is they may come with different things that may not suit you. So they may come packaged with a credit card, perhaps an offset account, or even life insurance, and they're all going to come with a fee. So you're going to get some bites taken out of that cash back. Plus, if you're changing lenders, you are going to have to pay a discharge fee. So you're already starting to lose some of that money that you're getting up front.
OK, what about the rate, though, on the loan with a cashback? It's a bit like retailers with a sale, but they put the price up and give you the discount on the higher price. Is it sort of the thing?
It can be similar to that, David. Some of the rates aren't bad. Some of them don't look too bad, but you've really got to look at apples with apples. So if you've got two lenders with the same rate and you're happy with the conditions around the cashback, that's a you beaut. But plenty of them come with conditions that just aren't going to suit you and are probably going to mean that within 4 years, any value you got through that cashback, you've paid in other ways. Some have a revert interest rate too, so it might be super sweet for the first year and then it's going to revert to something else.
Gee, there's a lot to go into it, isn't it? Because, that $4,000 up front, you go, boy, we can buy a new lounge suite with it or whatever, but it is buyer beware with these. Were you surprised?
I am surprised, but having looked at it from, like I mentioned, with retail, often cashback offers there were tricky too. It takes a lot of work to get the money, and I think that's what's most important. If you are going to do it, know that you're going to have to do quite a bit of work to make sure it's going to pan out and it's going to be suitable.
Who offers them? Is it a wide range of lenders or is it sort of the newbies, the digital banks?
We're seeing big banks offering this. This just shows how competitive it is. And I guess my general message is rather than just being seduced by the cashback, know that lenders are competing for your business. So really drill down on the best interest rate.
Okay, so negotiating the interest rate could be more effective than a cashback?
Yeah, because look, most people are taking a loan out of over a long time. So if you do the maths, you're probably going to be better off. Yes, you could buy that lounge suite to pop in your home, but overall, if you're looking beyond a couple of years, you're probably going to do better with a really, really good interest rate.
Great advice. Kate, thanks for joining us.
Thank you.
Perfect. Up next, look lux for less, how to dress the part without spending the big bucks.
Hi, I'm Alec from Equity Mates Investing Podcast, and here are my top tips when it comes to deciding what to invest in. Everyone in Australia wants to buy a house. That's the Australian dream. But house prices are out of reach for a lot of everyday people. Luckily, the share market offers a range of investing options to help you grow your wealth. The most common type of investments in the stock market are individual companies. Commonwealth Bank, BHP, Coles, Afterpay. Investing in companies is great, but they require a lot of time to research and are not for everyone. If you are time poor or not confident in investing in an individual company, there are two great options for you to consider. The first, just buy the whole market. You can buy an index fund that holds all of the biggest companies, or you can buy a fund that tracks a particular theme. The second option is to back the professionals. You can buy listed investment companies that are managed by some of the best investors in Australia. You buy shares in their company and you make money when they make money from their investments.
Welcome back. You're watching Your Money and Your Life, the show that's all about saving, investing and enjoying your money better. Now, it's a known fact that if you look good, you generally feel good, but with the cost of living creeping up each year, sometimes the purse strings need to be tightened when it comes to personal upkeep. But it's not all bad news. There are ways that you can look $1 million without spending anywhere near it. Here, money expert Shivani Gopal shares some tips on looking lux for less.
Let's start with clothing. On average, women only wear 40% of their wardrobes, and a staggering 23 kilos of that ends up tossed away as landfill. A smart option is to rent garments rather than buy them. Instead of shelling out thousands of dollars on outfits you're only likely to wear once or twice, this is a good alternative.
There has definitely been an increase in renting instead of buying over the past 9 years. So GlamCorner started in 2012, which was super exciting. It was only 30 garments in a small little warehouse sharing between consumers. And now we're over 30,000 garments and growing. And it's such a fun and exciting way to wear amazing clothes, feel awesome, and save money whilst doing so.
GlamCorner gives you access to an endless wardrobe of local and international designers in sizes from 6 to 24, with prices starting from just $39.
We also have an amazing section, our pre-love section, where you can get up to 90% off.
For even more savings, there is a membership option. For $149 a month, you get 3 items delivered straight to your door. You wear them, send them back, and rotate as many times as you want. You can have up to 12 items in 1 month.
By renting, I'm saving thousands of dollars each year, and now I can actually put it into a holiday fund, and my partner is so excited that we can go away, and also he gets his wardrobe space back.
There are also many ways that you can save money on other things, like self-care. If you're a lover of frequent haircuts, for example, or blow dryers, ask your salon for a group of 10 packages. They'll love you for the cash up front, and you'll find yourself with up to a 20% discount on services you were already splashing out on.
Another great way to save money is by coming into one of our trading nights. A lot of the top salons in Sydney have them, so it's great for our young and upcoming stylists to learn and train at a fraction of the cost to you guys. It's a win-win for everyone.
Try paying in bulk or upfront for your nails, massages, or even your personal trainer. When it comes to men's grooming, a cost-effective way of shaving is to take advantage of the subscription-based company Oscar Razor. This company's mission is to provide high-quality razors at a fraction of the cost with the convenience of home delivery. It could shave your costs by up to 40%. The last tip is to be smart when shopping online for makeup, accessories, skincare, and anything else to pamper yourself with. Compare prices.
After the break, Australia's top share experts give their inside tips on which stocks they're recommending. Welcome back. You're watching Your Money and Your Life. Now, don't know what to put into your share portfolio? Well, let's get straight into this week's stock recommendations with our experts, Superhero Trading App founder John Winters and fund manager Michael Wayne from Medallion Financial. Michael, how's it looking at the moment?
It's been pretty buoyant the last few weeks. It was looking a little bit hairy there. In February, we saw bond yields around the world moving above 1% in Australia and above 1% in the US, but that seems to have found a bit of a base at the moment, and equity markets are comfortable with that.
John, what's the traffic like on Superhero?
There's a huge demand for tech-related stocks, and we see them continuing to outperform as well. So really strong theme in the market and consistently hitting new highs.
Yep. Let's kick off with a tech stock. One of the two we're going to take a look at today as Xero, the accounting software platform for small businesses. Started out of New Zealand and now has taken on the world. John, how's it come up?
Yeah, it's been a terrific story over a long period of time. Absolutely phenomenal growth rates, but they've taken a really sort of offline business and digitised it in their go-to-market strategy. It's worked really well. They've built a huge amount of customers.
Well, they've emerged as the dominant player in Australia and New Zealand, and they're looking to achieve the same thing now in the UK and to some extent as well in the US. It took them 10 years to get their first million customers, and it's taken them, I think, 2 years after that to get their second million. So they've managed to transition from a startup company. They had their first year of profitability last year, their cash flow's growing, and they're making a good fist of it in new and larger markets.
So share price has been a phenomenal performer in the last 2 years or so. Is it worth buying at these levels?
Look, at these levels, I'll be tempted to hold, but if we do see a retracement like we saw only a couple of months ago, where the price gets to around $110, we would certainly be interested at those levels.
Yep, John?
Yeah, I agree with the long-term thematic. I think at these levels you would hold it. Longer term, very bullish, but at the moment you wouldn't be rushing in.
Okay, let's get into our second stock, and one that we've had a lot of feedback on, and that is Qantas, the big Australian, back in the skies at the moment, at least domestically, not so much internationally. Michael, is this an opening up story for the economy? Is it the start of a good rebound?
I think you've got to be careful with this one. It's very emotive, the flying kangaroo for many people. And sure, as the economy reopens and borders reopen, Qantas should definitely benefit from that. We have seen the domestic borders open up, and domestic travel and flights for Qantas has 3 times the margins of international travel. So we are starting to see numbers recover in the domestic market. Next year, the numbers for 2022 are meant to be better than pre-pandemic. So there is definitely some light at the end of the tunnel, but looking at it from a holistic perspective, history is littered with the corpses of airlines that have failed. It can be a very challenging and competitive space. You've got the currency, which is an input that always fluctuates. You've got the energy price. You've got to renew the fleet. Qantas's fleet these days is actually a lot older than it has been in the past. Right. So that's one way they've been able to boost up their earnings. They've delayed the renewal of the fleet. So that's one thing you do have to always keep an eye on. But I think from a short to medium term perspective, it's more of a trade. But from a long-term perspective, I always see a lot of challenges for airlines when you least expect it.
They are complex businesses, aren't they? A lot simpler ways to make money. What do you reckon, John, on Qantas?
Yeah, I think it is a very iconic brand. Everyone in Australia knows it, and pretty much all of Australia loves it as well. So premium product to what else is in the market. They do have higher margins. The domestic market, if you look at the Qantas domestic market as well as Jetstar, has been a lot bigger than the international market for a number of years. So I do think as you start to see domestic travel ramp up, you will start to see earnings come back and ultimately the share price perform.
Okay, all right, guys. Thank you for that. Good to see you. Some good advice there on both Xero and Qantas. Well, that's all we have time for this week. But for more money tips and expert advice, be sure to head to the Your Money and Your Life website. And if it's share advice you're looking for, you can always join me every weekday for the call at midday Eastern Standard Time on AusBiz and also 7plus. Next week on Your Money and Your Life, what sort of investor are you? We help you find out. And you are what you negotiate. Tips and tricks to get more cash.